thing we can safely say is that the real estate market will shift. We can't say when or how much, but we are pretty confident that the only constant in real estate is that the market shifts. Sometimes it's a buyer's market, sometimes it's a seller's market, sometimes it's moving from a buyer's market to a seller's market or vice versa. Sometimes it moves quickly, sometimes slowly. The key question isn't when it will shift, unless you have a crystal ball, no one knows when. But the key question is, are you ready for a shift? Are you ready? In today's episode, we're going to dig into what often goes wrong during a shift in the real estate market and how you can prepare to turn a potential nightmare into an opportunity of a decade. Hello, and welcome to the Wealth Wisdom Financial Podcast. We believe when conventional financial thinking does not get you where you want to go, you need wealth wisdom. Please hit that subscribe button so you never miss an episode. And if you're watching on YouTube, the comments are open. Please like this video, comment. We'd love to hear from you. If you're listening on a podcast, we'd love a 5-star rating and review as well. Okay, so last week for our dedicated listeners, we discussed an idea called the buy, borrow, die strategy, or BBD for short. If you haven't listened to that episode, please go back and listen to it. Check it out. Today, we're going to talk about one of the significant dangers of using that strategy. So I want you to know what that strategy is. And it's the middle part of the strategy. That's buy, borrow, die. Borrow is often where things go wrong and people become what's called over-leveraged. Over-leveraged is when you borrow so much that your debt is relatively high to your equity or to your initial investment. When the real estate market shifts and a real estate investor is over-leveraged, it can lead to significant challenges and potential losses. And like significant losses, it could be had as well. Now, we've seen shifts before, and we've seen what happens to people who are over-leveraged before. Probably one of the most similar to what we're experiencing now, and one of the most familiar to us is from the 1990s. In the 1990s, the US, the United States, experienced a significant increase in interest rates, which had a profound impact on the real estate market. The period from the late 1970s to the early 1980s saw a series of aggressive interest rate hikes implemented by the Federal Reserve to combat surging inflation. Maybe you were alive during that time. Maybe you remember it. Maybe you were a kid, you don't remember it. That's part of why I wanted to remind you what happened. Now, there were some key effects of what happened because of this rapid interest rate increase in the United States real estate market during the same time. I've got 7 of them. Housing affordability declined. The higher interest rates made borrowing more expensive, resulting in increased mortgage rates. And as a result, housing affordability declined for many potential buyers. And as interest payments led to higher monthly mortgage costs, right? So it was less affordable to buy a house. Sound familiar? 2, slower home sales because people weren't buying as much. There was not demand for homes, which led to slower home sales. Many potential home buyers were priced out of the market, causing a slowdown in real estate transactions. 3rd, there was a kind of a price correction. The combination of higher interest rates and reduced demand, the first 2, put downward pressure on home prices. And in certain areas, real estate values experienced a price correction leading to a decline in their property values. So if the people were building up equity, they lost a lot of that equity. Number 4, commercial real estate also had challenges. It wasn't just residential. There were difficulties due to those, again, rising interest rates. Higher borrowing costs made it more expensive for businesses to finance real estate projects, leading to reduced construction, less development activity, right? If it costs more to borrow to buy the concrete and the wood, you're going to build less properties, whether they be commercial or residential. 5th, there did end up being some distressed properties and an increase in foreclosures. With home prices declining, the interest rates increasing, some homeowners found themselves unable to afford their mortgage payments or their home equity line of credit payments, and that resulted in an increase in distressed properties and foreclosures, preventing further pressure on the real estate market. It's kind of a snowball in a negative way. Number 6, regional variations. The impact of the rising interest rates were not uniform across the entire country. Some regions saw more severe effects than others, depending on what was happening in that local economy and the housing market dynamics there. And then 7th, this didn't just stick with real estate. There was a wider economic impact. The challenging real estate market conditions contributed to all kinds of broader economic repercussions, as reduced housing activity and falling property values affected consumer spending, construction jobs, related industries, all kinds of things. So this rapid increase of interest rates in the 1980s represented a significant economic challenge for the real estate market and for the broader economy. However, as the Federal Reserve gradually eased its monetary policy and interest rates began to decline in the later 1980s, the real estate market and the economy started to recover. And by the end of the 1980s and into the 1990s, the real estate market stabilized, housing activity began to pick up. It's interesting to note that the stock market also surged during the 1980s with some wide volatility, while that real estate market was also experiencing its shift. But in the 1990s, as both of them were kind of increasing significantly, both the real estate and the stock market. It's kind of interesting. But let's go back to the late 1970s, early 1980s. As we discussed very briefly way back in episode 67 from November of 2020, a certain radio personality developed a pretty strong stance against debt, the borrow part of the buy, borrow, die strategy, but debt in general, a pretty strong stance against it due to some of his own experience of being over leveraged when the real estate market had these shifts due to increasing interest rates. Go back to that episode to learn more about how he started out as a real estate investor, but filed bankruptcy when his bank was sold to a larger bank, which demanded immediate repayment of his loans. We're definitely seeing some banking consolidation. If you're experiencing maybe some changes in how your banking relationship works because you were at a smaller bank and it was being sold to a larger bank, comment, let us know what you're experiencing. We'd love to hear. So that's the history. Here's kind of a recap of what could happen when the real estate market shifts and an over-leveraged investor is affected, how this impacts us if we're over-leveraged. So the whole idea of property values increase, right? It can lead to decreased property values. When this happens, the property is worth less than the investor initially paid for it, which can lead to negative equity, right? You're actually in the red rather than having a positive equity, and the outstanding loan balance is higher than the property's current value. That can be pretty scary and can impact then ability to get future loans or ability to have a good credit score. All kinds of things can be impacted there. There's also cash flow issues, especially as we look at the wider impact on the economy of what happens in the real estate market. Rental income might decrease if we have this market shift. And there can be vacancy, lower rents being paid. And if an investor is relying on that rental income to cover their mortgage payments and expenses, then a decline in that cash flow is going to make it difficult to meet those financial obligations, which then can kind of cascade into some loan defaults. If you're unable to generate enough rental income or you lack the financial reserves to cover mortgage payments and other expenses, you might have to default on your loan. And this can trigger foreclosure proceedings, can lead to the loss of the property and negatively impact your credit score. And then what if you want to refinance? You've got all this equity that you built up and it's in the walls of the house. In a market downturn, lenders may become more cautious and less willing to refinance existing loans, especially if properties have decreased in value. This can leave over-leveraged investors with fewer options to restructure their debt or improve their financial situation. There's also, if you are hoping to sell, maybe you've got a college tuition to fund or you're about to retire and you decided to sell some of those properties before, making that kind of transition. Selling in a declining market can be very challenging, especially if property values have dropped significantly. Over-leveraged investors, if add to that, they find it especially difficult to sell their properties at enough of a balance, right? Enough of a sales, net to cover the outstanding loans. If they can't do that, then they've lost money and they have to figure out how are we going to repay those loans from elsewhere. And then of course there's, we're big fans of uninterrupted compound interest. And if property values go down, that is resulting in a loss of equity, a loss of your wealth. And it takes a bigger increase to get back to where you were, plus the increase you were expecting. So as property values decline and loans remain high, investors can experience significant losses in both their equity in the properties and their overall net worth. And that can have permanent impacts on their trajectory going forward. And then finally, what happens in the real estate can overflow into our personal finances and put our personal finances at strain, especially when we're over leveraged. That means we might have to take personal money to help out on the real estate side. And if we have maybe a personal guarantee on the loans, our personal finances could be at risk, or we might have to use those personal assets to cover losses or other debt obligations. So that kind of maybe makes us eat, ramen or, that kind of thing for a while to make sure that we're able to get through that experience. Now, I'm not sharing this today to say never borrow money. Many people use other people's money, OPM, other people's money to great effect toward their real estate goals. And I'm also not trying to scare you too much, but just enough to be a little more cautious maybe, or a little more thoughtful when getting close to the line of using too much leverage in real estate. What I'm saying is that I believe it is wise to use other people's money to build wealth, but you have to be wise in using other people's money, OPM, to build wealth. So I've got some ideas to help you mitigate some of the risks associated with over leverage. So you might consider these kinds of strategies to help you be wise in the use of other people's money to build wealth. Number one, maintain adequate cash reserves. Having sufficient cash reserves can help investors weather those market downturns by covering expenses when rental income decreases or there's an unexpected cost increase. By building up your own liquidity too, you can bring more power to the negotiating table when you're asking for OPM. It increases your power, your ability to have more self-determination in that negotiating process. If you're putting in 20%, that's a lot different than if you're putting in 3%, or if you're putting in 50% of your own money, you can often get a lower interest rate from the other 50% as compared to 20 or even 3, right? So having your own liquidity helps not only during the downturn, but also to help you get the other people's money. Of course, we have to mention the very common diversifying, right? You want to diversify your investments, have different types of properties and different kinds of geographic locations. That can absolutely reduce your risk. Because a market downturn in one might be offset by stability or growth in another, right? Not everything shifts all at the same time or all the same ways. I have to add to that, also build assets that aren't correlated to real estate, but maybe even allow you to do real estate better. 1+1 real estate properties in that portfolio plus another diverse asset in a different sector, those can often add together to be more than 2 if they're mutually beneficial. So look for diversified investments that are mutually beneficial that way. Number 3, moderate your leverage. I mean, how simple is that? Avoid excessive borrowing and maintain a reasonable debt to equity ratio. This reduces the potential impact of a market shift on your financial stability. Now, sure, that sounds well and good, but what if, here's the question most people don't ask when they're thinking about moderating their leverage. What if you could use leverage that you're in complete control of the repayment schedule? Complete control. And how would that change the impact of a market shift on your ability to repay that loan? If, let's say you're paying $1,000 and then the market shifts, you lose a renter, you don't have income coming in. What if you could stop paying that $1,000 and not be at risk of foreclosure? That'd be pretty cool, right? Now, number 4, stress test your investments. Before making a purchase, consider how that investment would perform under different market scenarios, including some of these downturns. Kind of go back. If we were in 1982, would this investment still make sense? This can help you identify some of those potential vulnerabilities and make a plan for how you're going to get through those. Never, ever underestimate the power of multiple scenarios. Best case, worst case, middle of the road case, right? I'd love to run those kinds of scenarios with my clients, with myself. It's a very powerful thing to do to kind of stress test things. Next one, monitor market trends. Now, you want to stay informed of the real estate market, economic conditions, be proactive, help you make timely adjustments to your investment schedule, but balance that with knowing you can't time the market, right? Knowledge is powerful, but it's not all powerful. Can't time the market always, but also think of you're watching, you're seeing what's happening, you're staying informed. How are you going to apply that knowledge? Because even just seeing it, you got to actually react and do something, be proactive maybe before rather than just reactive. But also be very careful as you're reading news to carefully discern knowledge from prediction and speculation. You want to act on real knowledge. You want to be very cautious when acting on prediction and speculation, because remember, you can't time the market perfectly. What somebody says might happen a year from now could happen in 6 months, or it could happen in 6 years. You don't really know. So be cautious there. And then finally, my last tip is to have an exit strategy. Plan ahead for how you would handle a market downturn. Having a well thought out exit strategy can help you make decisions quickly if the market does take a negative turn. You've kind of played around with the crystal ball, run all the different scenarios, your strategy, and then you recognize, hey, this is happening now. I'm ready to make my exit. I'm ready to do X, Y, or Z. Now, a true financial plan not only includes the aspects of, a planned debt to equity ratio that you try to stay, within a range there, maybe liquidity ratios, maybe diversification and how much of your portfolio is going to be in different kinds of assets, parameters for the deals you're going to make. All of those are included in a financial plan. But a financial plan also includes the criteria for when and how you're going to exit that investment or that strategy that you're using. It might be upon your death, as in an estate plan and the buy, borrow, die strategy. That's often what it is. But it could also be an exit at a specific age, or an ideal increase in equity, or a specific tax year to get certain tax advantages. The important thing is to have those parameters in place and adjust them as life and real estate changes. But absolutely have an exit strategy. And you could have a best case exit strategy, a worst case exit strategy, and a middle of the road exit strategy. Have fun with this. Dream, plan, make it your own. So in essence, being over leveraged in the shifting real estate market can magnify the impact of market fluctuations and increase the risk of financial challenges and losses. Everyone, or most people, 99% of the people maybe, are impacted by a real estate market shift, but those that are over leveraged are impacted the most. But you can have prudent financial planning, you can do some risk management, you can have a thorough understanding of market dynamics, and that can be crucial to make sure, 1, you're not over leveraged, and 2, you're able to navigate situations successfully no matter how they change. Remember, you can't time the market, but you can be cautious and careful in your use of leverage, and that can help you have opportunities no matter how things shift or when. Now, I went very quickly through this episode. We have a lot more in-depth resources available in the Wealth Wisdom financial community to help you determine questions like, how much leverage is too much? Or maybe you're thinking, what is a good debt to equity ratio based on my unique risk tolerance and financial goals? You can get those deeper dives by joining the community. It's available right now at www.wealthwisdomfp.com/community. Even at 2 a.m., the community is available by web browser or as a handy-dandy smartphone app. The other thing that I'll tell you is some of those like little extras that I put in, like building up your own liquidity to bring more power to negotiating tables, having assets that are not correlated to real estate, having the ability to leverage where you're in complete control of the repayment schedule, having a predictable financial strategy that isn't going to shift with the real estate market. You can learn way more about that too in the Wealth Wisdom financial community. So go ahead, go over to our website, learn more. The link again is www.wealthwisdomfp.com/community, or you can go to the link, of course, in the episode description. So this rounds out our little mini series here about real estate. I want to let you know that we've got some really, really exciting things planned in September. We have some amazingness that is about to come your way. We're going to put a bonus in the description of this episode. Thank you so much for listening to the end. Thank you so much for checking out the description. There is a secret information that you can find out before anyone else can find out. You just have to click the link, go there, learn a little bit more about it, and see if you want to be extra proactive in getting something really amazing that we're bringing to you in September of 2023. And of course, if you're checking this out in September, you can still use that link. It'll still work. Or October, November, you'll still be able to take advantage of that information. Okay, that's it for today. Don't want to reveal too much about that surprise. Thank you so much for joining us. Hit that subscribe button. Live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.